The concept of three rivers. A bearish reversal pattern is a technical analysis technique used to predict changes in market trends, especially signaling a transition from an upward to a downward trend. This pattern is observed within the price charts of financial markets and consists of specific candlestick formations over 3 trading sessions. The first session presents a long bullish candle, indicating strong buying pressure. This is followed by a smaller candle that may open higher or within the body of the first candle, showing the beginning of a slowdown in buying. The third session unveils a long bearish candle, opening within or below the second session's close and closing well into the first session's body. This signifies that sellers have overtaken buyers, suggesting the potential start of a downward trend. In the conclusion section titled Navigating the Financial Rivers, the discussion centers on the importance of recognizing such patterns and understanding their implications for investment strategies. It emphasizes the need for investors to remain adaptable, using these signals to make informed decisions. By identifying bearish reversal patterns like the three rivers, investors can better assess when the market might turn against their current holdings, thus acting preemptively to protect their investments or capitalize on upcoming opportunities. This guidance serves as a reminder that successful navigation in the financial markets requires not only the ability to identify pertinent patterns, but also the wisdom to act on these insights in a timely and decisive manner. The 3 stars in the north is a bearish reversal pattern that traders and analysts use to forecast a potential change in an asset's bullish trend. This pattern is recognized on a stock chart by 3 consecutive bearish candlesticks, each opening within the body of the previous candle but closing lower than the one before. These candlesticks appear after a notable uptrend, suggesting a slowing momentum and possibly signaling that the asset price is set to move downward. The first candlestick is often the largest and shows the last significant push of buying pressure before the trend begins to weaken. The second and third candles show continued selling pressure, with each day opening at or near the previous day's open but closing at a new low. This pattern indicates that buyers are losing control to sellers, leading to a potential downturn in the asset's price. Understanding this pattern can be vital for investors looking to protect gains or for traders looking for short positions in the market. By recognizing the early signs of a trend reversal, investors can make informed decisions about reallocating assets or setting up defensive positions to hedge against potential losses. The 3 stars in the north pattern, with its distinct arrangement and implication, serves as a helpful tool in the arsenal of technical analysis strategies. The 3 stars in the north is a bearish reversal pattern used in technical analysis, indicating a potential shift from an uptrend to a downtrend in the market. Identifying this pattern involves recognizing 3 key characteristics on a financial chart. The first is a series of 3 consecutive long-bodied candlesticks that are each moving higher than the last, which all appear after a significant uptrend. These candlesticks signify that buying pressure is starting to wane. The second characteristic is that each of the 3 candles opens within the body of the previous candle, but still moves higher, showing that buyers are becoming exhausted and sellers are beginning to take control. The final characteristic to confirm the pattern is relatively small or non-existent lower shadows on each candle, indicating that there is little to no buying pressure pushing the prices up from their lows during the session. When these elements all come together, they suggest that the momentum of the uptrend is weakening and a reversal to a downtrend could be imminent. Investors and traders often use this pattern as a signal to consider taking profits on long positions or preparing for a potential shift in market direction. Understanding how to identify the 3 stars in the north pattern can help investors better manage their portfolios by identifying potential turning points in the market. The 3 stars in the north is recognized as a bearish reversal pattern within the arena of technical analysis, typically identified in an uptrend, signaling potential reversals or downward shifts in market sentiment. This pattern comprises 3 consecutive bearish candles, each opening within the previous candle's body but closing progressively lower. The presence of this pattern suggests a weakening in buying momentum as sellers begin to dominate, potentially leading to a market downturn. The interpretation of market sentiment through the 3 stars in the north is integral to understanding potential shifts in market dynamics. Initially, the pattern's emergence during an uptrend indicates sustained buying pressure. However, as each day passes with a lower close, it reflects a gradual decline in confidence among buyers, countered by increasing control by sellers. This shift is significant because it signals changing attitudes among market participants from optimism to caution or pessimism. For investors and traders, recognizing such patterns is crucial. It offers insight into the early stages of market sentiment shifts, allowing for strategic adjustments in portfolio management to mitigate potential losses or capitalize on short-selling opportunities. Moreover, while the 3 stars in the north provides valuable predictive insights, it is often advised to corroborate this pattern with other analysis tools for a comprehensive market evaluation, ensuring decisions are not based on a single indicator. This approach enhances decision-making precision, aligning strategies with overarching market trends and sentiment. The 3 stars in the north pattern marks a potential bearish reversal in the market. This pattern occurs when, after a strong uptrend, the market begins to show signs of weakness through specific candlestick formations. To classify this pattern, one should observe 3 key candlesticks appearing in succession. The first is a large white candlestick indicating a continuation of the bullish trend. However, what follows is crucial for the identification of the pattern. The next 2 candlesticks are smaller and both show a marked decline in price, with each closing lower than the previous one. These 3 candlesticks, resembling 3 stars in a descending trajectory, signal that the upward momentum is losing strength and that a bearish reversal could be imminent. Understanding this pattern is about recognizing the shift in market sentiment from optimism to caution or even pessimism. The initial large white candlestick represents the peak of bullish sentiment. The subsequent smaller, lower closing candlesticks symbolize the growing uncertainty and loss of confidence among investors. When traders and investors identify this pattern, it indicates a possible turning point where the previous bullish trend may reverse into a bearish trend, suggesting it might be time to consider defensive strategies or looking for opportunities to short the market. In summary, the 3 stars in the north pattern acts as a warning signal for investors, suggesting that the bulls are exhausted and the bears might be taking control. Recognizing this pattern involves observing the formation of 3 specific candlesticks in an uptrend, signaling the potential end of upward momentum and the start of a downward shift in the market. In discussing the 3 stars in the north, a bearish reversal pattern, it is crucial to consider the key factors for confirmation to ensure the pattern's validity and potential impact on market predictions. First, the pattern typically emerges during an uptrend, signifying a potential shift in market sentiment from bullish to bearish. The initial component of this pattern is a long white or green candle, indicating strong buying pressure. This is followed by a smaller candle that gaps higher, showing a continuation of the uptrend but with less momentum. The third candle, which is crucial for confirmation, gaps higher yet closes within the body of the first candle, signaling a weakening of the uptrend and a potential reversal to bearish market conditions. Volume plays a significant role in confirming this pattern. Ideally, the volume should be diminishing as the pattern forms, with the first candle showing the highest volume and the third showing a significant decrease. This decrease in volume supports the interpretation that buying pressure is waning and sellers are beginning to take control. Moreover, it is essential to monitor subsequent trading days for confirmation of the bearish reversal. A confirmation would be further price decline following the pattern, especially if it occurs on increased volume. This suggests that the market has accepted the reversal and the bearish trend is likely to continue. In summary, the 3 stars in the north pattern serves as a warning of a potential shift from bullish to bearish market conditions. However, traders should look for confirmation through additional indicators such as declining volume and further price decreases to make informed trading decisions. The 3 stars in the north is recognized as a bearish reversal pattern observed in financial markets. It signifies the potential end of an upward trend and the beginning of a downward movement in prices. This pattern consists of 3 consecutive candlesticks that typically appear at the top of an uptrend. The reliability of this pattern in predicting a market reversal is influenced by several factors, providing insights into its strengths and weaknesses. In the context of its reliability, this pattern is considered to offer a moderate level of confidence in signaling a potential reversal. Its occurrence after a sustained uptrend adds to its credibility as it suggests exhaustion among buyers and a growing interest among sellers. However, like all technical analysis tools, it has limitations that investors must consider. The primary caveat with the 3 stars in the north pattern, and indeed many candlestick patterns, is that it requires confirmation from subsequent price movements or other indicators to validate the reversal signal. This confirmation could come in the form of a significant drop in price following the appearance of the pattern or other technical indicators signaling a change in market sentiment. Additionally, the effectiveness of this pattern can be influenced by market conditions and investor sentiment. During highly volatile periods, the reliability of the pattern may decrease, as sudden price movements could disrupt the formation or interpretation of the pattern. Therefore, investors are advised to use this pattern in conjunction with other analysis tools and not rely solely on it for making trading decisions. In summary, the 3 stars in the north pattern serves as a valuable tool in the arsenal of technical analysts for identifying potential bearish reversals. Its effectiveness, like that of any technical analysis tool, is enhanced when used alongside other indicators and considering the broader market context. Recognizing the pattern's limitations helps investors apply it more judiciously, potentially leading to more informed and successful trading strategies. The 3 stars in the north is a bearish reversal pattern that signals a potential shift from an upward to a downward trend in the stock market. This pattern is characterized by 3 consecutive long-bodied candlesticks that each open within the body of the previous candle but close at a lower point, suggesting a weakening of the market's upward momentum. When analyzing this pattern, it is crucial to consider its synergy with other analysis tools for a more comprehensive market outlook. Integrating the 3 stars in the north pattern with other analysis tools enhances the predictive accuracy of potential market movements. For instance, using this pattern in conjunction with volume analysis can provide further confirmation of a trend reversal. A significant increase in trading volume accompanying the formation of this pattern indicates strong selling pressure, reinforcing the bearish outlook. Moreover, adding moving averages into the analysis can offer additional insights. If the 3 stars in the north pattern forms below a significant moving average, like the 50-day or 200-day moving average, it may signify strong resistance, making it harder for the price to move back up. This convergence of signals from different tools provides a more robust foundation for forecasting market directions. Technical indicators such as the Relative Strength Index (RSI) or the Moving Average Convergence Divergence (MACD) also complement this pattern well. For example, if the RSI shows an overbought condition or the MACD indicates a bearish crossover at the time the 3 stars in the north pattern forms, it further validates the potential for a market downturn. Utilizing the 3 stars in the north pattern in harmony with these additional analysis tools allows for a multidimensional approach to market analysis. This comprehensive strategy not only improves the accuracy of predicting bearish reversals, but also helps in making well-informed investment decisions by providing a clearer picture of market sentiments and trends. When discussing the 3 stars in the north bearish reversal pattern, it's essential to understand both the pattern itself and common mistakes and misinterpretations associated with it. This pattern is part of technical analyses used by traders to predict a potential shift from an uptrend to a downtrend in the market. The 3 stars in the north is identified by 3 consecutive bearish candles following an uptrend, each opening within the body of the previous candle and closing near its lows, ideally lower than the preceding day. This creates a staircase-like downward trend, signaling a weakening of buying momentum and a potential reversal to bearish sentiments. One common mistake is misidentifying the pattern without considering the preceding market conditions. It is crucial that this pattern follows a clear uptrend for it to serve as a meaningful reversal indicator. Without a prior uptrend, the pattern lacks the context needed for accurate interpretation. Another frequent error is overestimating the strength of the signal without corroborating it with other indicators. While the 3 stars in the north suggests a bearish reversal, traders should seek confirmation from additional technical indicators such as volume analysis or momentum oscillators to validate the potential shift in market sentiment. Ignoring the significance of the closing prices in each candle can also lead to misinterpretation. Each candle in the pattern should close near its low, emphasizing the bear's control in the market. Neglecting this detail may result in an accurate pattern recognition, but a misunderstanding of its strength or potential impact. In summary, the 3 stars in the north is a bearish reversal pattern that requires careful confirmation and a clear understanding of its characteristics and surrounding market context to be used effectively. Avoiding common mistakes and misinterpretations is key to employing this pattern successfully in market analysis. Understanding the 3 stars in the north Bearish reversal pattern and setting entry and exit points can significantly enhance one's trading strategies. This pattern indicates a potential reversal in the market trend from bullish to bearish, signaling traders about a change in market sentiment. The pattern emerges over 3 days during an uptrend, with each day opening higher than the previous day's close, but closing down within the range of the first day. This sequence suggests weakening buying pressure and the onset of selling pressure. In setting entry points after identifying this pattern, one should wait for additional confirmation. This could be in the form of a significant drop in price below the last day of the pattern, which suggests that the bears have taken control. An entry point is ideally set just below this confirmation level to capitalize on the anticipated downtrend. Exit points, conversely, are crucial to securing profits and minimizing losses. Set an exit point at a price slightly above the highest point of the pattern for a stop loss to protect against losses if the market does not move as anticipated. For taking profits, consider setting a target based on historical support levels or using a predetermined risk-reward ratio that suits your trading strategy. Both entry and exit points are essential for effectively navigating market dynamics, particularly when dealing with reversal patterns like the 3 stars in the north. Properly timing these can significantly influence the success of trading activities, highlighting the importance of careful planning and strategy execution in trading. The 3 stars in the north pattern is a bearish reversal indicator in the context of technical analysis. This particular pattern emerges during an uptrend, signaling a potential reversal to a downtrend. It involves 3 specific candlesticks appearing in succession, each opening within the body of the previous candle but closing lower. This sequence suggests a loss of momentum in the prevailing uptrend and hints at a shift in market sentiment towards bearishness. When delving into variations and similar patterns, it's essential to understand that while the core concept remains the same, indicating a shift in market dynamics, small differences in the patterns can offer nuanced insights. For example, a variation might include a slight difference in the size of the candlesticks or variations in how sharply each candlestick closes lower than the previous one. These subtle differences can indicate the strength of the bearish sentiment and potentially offer a time frame for when the reversal might solidify. Similar patterns like the evening star or 3 black crows also signify market reversals but differ in formation and context. The evening star pattern occurs after a price high and is followed by a gap up, creating a short candlestick or a doji, which is then succeeded by a gap down and a long bearish candlestick. On the other hand, the 3 black crows consist of 3 long, consecutive bearish candlesticks that open within the previous candle's body but close lower, showcasing a strong and immediate bearish market sentiment without the intermediary presence of a smaller or indecisive candlestick as seen in the 3 stars in the north. Understanding these patterns, their variations, and analogous patterns are pivotal for market participants. It enables them to decipher potential market reversals, enhancing their strategy whether they are planning to enter, exit, or adjust their market positions. Through careful analysis, investors can better anticipate shifts, thereby managing risks more effectively and positioning themselves to capitalize on potential market movements.